We got a full house here. That's good. So customer success at scale. And for the past day and a half, I have heard this is definitely an important topic to a lot of people in the room. And before I go through these 7 steps, there's 2 things I want to put on the table. Number 1, I want to talk about the current state of the technology as a service business model. And then number 2, I want to talk a little bit about the 4 cost buckets in the technology as a service business model. And that will help set up our discussion. Okay, you ready? So let's talk about the state of technology as a service. Now, there's an index we have at TSIA. It's called the Cloud 20. We track 20 of the largest publicly traded cloud companies. And if you look at the revenue growth, it's a beautiful thing. If you look at their market caps, right, the revenue multipliers, it's a beautiful thing. And Wall Street is very excited about this business model. Why? Because everybody is chasing this. They call it the Wedge Model, right? You're creating platforms, you're spending money, you're creating platforms, you're getting customers on those platforms, but over time, it starts to get really profitable, right? A lot of customers on this one platform. This is a potentially beautiful business model. The challenge is getting to the second half of that wedge, getting to that profitability. This is a slide that Microsoft shared with some of their ISVs a couple years ago at one of their conferences, and they said, gosh, you know, we realize it just seems to be taking a little bit longer to get these business models profitable. And if you look at somebody like Salesforce, right, the 800-pound gorilla, approaching $5 billion in revenue, growing top lines, great. But they're now spending roughly $2 to acquire $1 of incremental revenue. What does that result in? An operating income that is either barely profitable or not profitable. Right? $5 billion, not making money. Go back to this Cloud 20 index. Every quarter, we look at how these companies are doing compared to the same quarter a year ago. Here you can see not much movement. On average, these companies are negative 1% operating income. Compare that to traditional technology companies. We have another index called the TSIA Service 50. We track 50 of the largest providers of technology solutions on the planet, Cisco and Oracle and SAP and all those folks. You can see in comparison what their business models look like. On average, they make 15 points of profit. Big difference. And I know when I talk about this, a lot of people say, well, Thomas, it's really not fair. These technology as a service companies are young, they're small, they're growing. Give them some time, give them some runway. But I just want to remind you, Oracle was profitable at $50 million of revenue and never had a hiccup until they hit almost $600 million. So this world that we're all living in right now is not our history in the tech industry. We are not used to companies having hundreds of millions of dollars of revenue, and we're still not making money. Now, I know Teen was here at the conference. Last fall, I had a chance to talk to him. We do a conference in Vegas every fall, and if you want to watch the whole discussion, it was interesting. You can click on the link there at YouTube. But we talked about this. I said, Teen, what is going on? Why are these companies not yet profitable? And Teen's logic is pretty much the logic that I hear consistently when people are defending the current state. First of all, right now, what are you all doing? You're investing a lot of money to get market share, right? To get people on the platform. And that's what's going on. So that's why our expenses are so high. But don't worry, right? When Wall Street stops rewarding that, we'll just take our foot off the gas. We'll spend less on sales and marketing, and we will become profitable. Anybody heard that logic to date? A couple hands, okay? And by the way, technology as a service is a little different because we have all these expenses, but our revenues are deferred, so we kind of have the separation between expense and revenue, so GAAP accounting isn't really fair to us. So this is the defense of why technology as a service is not profitable. So let's talk a little bit more about where we spend our money. right? Why is this business model not profitable? Well, there are 4 buckets of how you all spend your money that's important for customer success organizations to understand. The first one is COGS, right? So that's the direct cost of the platform plus typically support. That's cost of goods. Next, under sales and marketing, there are really 3 things you're spending your money on. The first one is customer acquisition, CAC, right? And this is what gets all the attention by the analysts. What's the CAC ratio? How much are you spending to acquire customers? Typically very high in SaaS companies. But there's 2 other things you need to do in this XaaS business model. You need to spend money on expanding customers, and you need to spend money on retaining customers. So let me show you a financial model, a profitable version of technology as a service. This is a model that comes from Tatango, from a great paper that they did on customer retention costs. And I think it's a very good model. And they said, well, what if we only, as a company, we spent 25% of revenue on COGS, we spent 30% on sales and marketing, 15 on R&D, 10 on G&A, we'd have a business model that was generating, right, 20 points of profit. It's a beautiful thing. It's a great vision to march toward. But let's look at the real data right now. So here you have, on the far left, that target model in terms of how much money you want to spend on COGS and how much you want to spend on sales and marketing and what your operating income would be. In the middle, we're tracking on how the companies in the Cloud 20 are doing. And on the far right, that's Salesforce. What does that tell you? So what I read in this data is that in the short term, we have a problem. You know, the problem of COGS, as you can see, as Salesforce is getting larger, COGS go down, right? Cost of goods is going down. That's great, right? But sales and marketing is going the wrong way. This is a long-term problem. So these are the 2 things that we're seeing technology as a service business models experience. My COGS can start to go down, but what I'm spending on sales and marketing keeps going up and up and up. So I'm going to submit to you today that I believe customer success as a capability is mission critical to making the technology as a service business model profitable. And I will defend that statement. So what you all do for a living in the long term is going to be the difference between your company's making money and your company's not making money. Period. Period. But to get there, you're going to have to scale. And so, we get these questions from the TSIA perspective all the time. People are either being asked to start customer success, maybe they transferred into a new SaaS company and they've been given the role of customer success. And these are the kind of things that are coming their way, right? What are we doing? What are we supposed to be focused on? What are our metrics? How do we scale? How are we going to be funded? So I'm going to give you a 7-step process, and it's linear. You really need to go through these steps one by one by one to create the scaffolding, to create a scalable customer success organization. And it starts with charter. It starts with charter. And I think this is a great discussion. I can just tell from the past day and a half, this is one of the things that we have a lot of consternation over, right? What should customer success be doing? What is our charter? So last year, we did our first ever benchmark for customer success organizations. We're going to do this survey again this year, by the way. It's open to the general public. Anybody in this room is welcome to participate. And these are the types of companies that participated last year. A lot of software companies standing up SaaS, a lot of pure SaaS companies, even some hardware companies that are now investing in customer success. And one of the questions we asked is, so how do your CSMs spend their time? The majority of their cycles. Tell me how they spend their time. Is it on adoption, helping customers adopt? Is it focused on retention, renewal? Is it focused on expansion, growing accounts, or something else? And the data is fascinating because when it came back, you can see these very clear differences. There are some customer success organizations, as you can see, they're spending 70% of their time focused on adoption. But look, there's others that are saying, we're spending 70% of our time on retention, getting that renewal. And then there's another group saying, no, we're spending like 60% of our time, right, growing accounts. So in today's world, this is not a one-size-fits-all. And I have to tell you, this is different than anything we've ever seen in the world of tech as it relates to services. If you go to a tech company, hardware or software, and you say, tell me about support, what do you expect out of support? The bumpers are pretty clear. What do you expect out of technical training? What do you expect out of professional services? And then you come to what do you expect out of customer success? And it's very clear, right? This is an accordion. Now, I'm very curious in the room here to see how this plays out. How many people, how you spend your time predominantly, how many people would say it's adoption? Just raise your hand. Pretty good crowd. Okay? How about retention? Pretty good crowd. Expansion? A little bit smaller. Something else. Okay, so those are the three big buckets. Great. So this is what we saw in the data as well. So the most common charter is adoption, followed by the folks focused on retention, and then expansion is a minority charter right now. But once again, it's different. Now let me ask this. Do you think the charter of your customer success organization is influencing how you are funded? Three possible answers: yes, no, don't know. How many people say yes? It's definitely charter and funding are aligned. Okay, not the common practice yet. How many people say no, it's not aligned? How many people don't know? Be honest, how many don't know? Okay, so that's sort of the state. So charter, the second step in this journey is really defining that charter. What's in, what's out is going to drive your financial model. So I'm working on a paper right now called a funding framework for customer success, literally designed to take into the CEO, CFO, the board, and say, let's have a conversation about how we're going to fund customer success. There's a 5-step process. I'm going to give you the crib notes here. Step number 1, right? What is the target financial model of your company? And you're going to see why this is so important. Second question. Will customer success have responsibility for support, yes or no? Right now, I see sometimes customer success does, sometimes it doesn't. You need to answer that. Third question. Will customer success be responsible for adoption? Sometimes they're not. Will customer success own the actual renewal? We see this happen. And last but not least, will customer success have some type of responsibility for expanding accounts? 5 questions. You need to answer these 5 questions. Why? So, I'll give you an example. So let's say there's a company that goes through this exercise. They establish their target financial model. By the way, the same one that Tatango, promoted that I put on the table earlier. And let's say they said, look, customer success, somebody else is doing support. Customer success, we want them to focus on adoption. But they're not going to own the renewals, the actual renewal. They're going to help with adoption. Then I would submit to you, in this financial model, the company feels they can afford to spend about 6% of total revenues on retention. You're in customer success, you're going to get a piece of that. You don't own the actual renewal, so you get maybe 2, 3, 4% of total company revenues. Makes sense to hit the 20 points of profit to invest in customer success. You follow my logic? Comfortable? Now, what if another company goes through the same exact exercise and they answer the questions differently, right? Customer success, we have the same target financial model. Customer success owns support. It's going to own adoption. It's going to actually own the renewal. And it's going to have some responsibilities to grow accounts. By the way, that's the salesforce charter in Customers for Life. It's exactly what it looks like. I would submit to you, you get to draw on dollars, you get support dollars, 10%. You get all the retention dollars, and you get the expansion dollars. That's over 20 points of total revenues. So the logic here is depending on what your charter is, if the charter's an accordion, funding's accordion. And in these models, I would submit to you it's going to range somewhere between 3 and 20% of revenues, depending on what you're asked to do. Does that make sense? Follow? Good. And here, once again, I said customer success is going to be critical to profitability in the long term. Why? It's this data right here. Pacific Crest surveys, they work with invest in SaaS companies, they do a survey of these companies, and they find right now their companies are spending, like Salesforce, over $1 to acquire $1 of revenue from a new customer. But revenue from existing customers, renewing, expanding, that's less than 20 cents on the dollar. Cost-effective revenue growth. Where is it going to come? Not CAC. It's retention, it's expansion. Who is going to be potentially in the epicenter of those conversations? You. If you've given those charters, and what we're seeing again and again, it's more cost-effective to do retention and to do some of the smaller expansion activities through customer success than to apply sales resources. So this is the math that makes technology as a service a profitable business model. Just curious from the audience here. How are you funded right now in customer success? How many of you are COGS? You're considered cost of goods. Couple? Because we definitely see this. All right. So maybe 15%. How many are under sales and marketing somewhere? Okay, so not half. How many are something else, G&A or R&D? Oh, a couple here. Yep, so maybe 10, 15%. How many just don't know? Being honest, you're not sure where you're, okay. Do you see that, though? Do you see that? This is where we are in the industry right now. Just like with our charters, the financial models are not crisp yet. This is why you want to have this dialogue. Why are we confused about our funding? We're not having this conversation in a constructive way. Now, you have your charter. You have some bumpers on how much you should be funded. What do you have to do next? You want to think about what are the practices required to truly scale this business. And here I have to say, unfortunately, I have a little bit of bad news for you, okay? The last book we published, B for B, and there's copies out there on the table, you're more than welcome to grab one. We talk about this virtuous life cycle in the technology as a service business model. You land customers, right? It's great. Then you want them to adopt. And then you want them to expand. And then they're really happy and they renew, right? 4 key phases. Well, in the technology industry, for 40 plus years, we are very good at landing customers, getting them to make the deal. And we've been pretty good at renewing. But there's been a bit of a no man's land in between adopt and expand. Why? Because in the old models, it was capital. When customer writes that big $1 million check, where are they going? They're not going anywhere, right? Now, in the models that you live in, that's not true. They're paying a little bit. And 2 months from now, or 3 months from now, they might go somewhere. We do survey work for a living at TSIA. We have changed our survey platform, off-the-shelf survey platforms 4 times in the last 6 years, looking for the right one for us. We would have never done that if we were buying the license. So, unfortunately, as an industry, the practices for adopting and expanding are not well understood yet, but they're starting to emerge. So this is what we call a practice map, and there's a lot of activities here when you think about onboarding, doing enablement, adoption monitoring, customer analytics. These are things that companies that are, hundreds of millions, billions of dollars in the tech industry never really had to invest heavily here. Now we're trying to figure it out. And it's interesting that last year in the survey I told you about, one of the things that we tested on were what types of practices are in place, right? And just simple yes and no, are you doing this? One of the answers that I found fascinating, that last practice, percentage of customer success organizations that have a formal adoption framework in place. It's not a common practice yet. What do I mean by that? How do you know the difference between low adoption and high adoption? How do you define that? And what's the difference between high and effective adoption? That needs to be defined somewhere for your CSMs, for your company, not common practice yet. So it's a journey as we figure these things out. And it's not just getting the inventory, it's about process quality and adoption. And this is something we've audited service processes for years, and we have a model here. And I want you to think about this as you're, once again, customer success at scale. We need to understand the required practices, and they need to be high quality. What's high quality look like? This is a left to right model. It starts with simple questions of, do we even have the practice in some PowerPoint? Yes or no? Okay, great. Is it well defined? The roles, the responsibilities, the inputs, the outputs. Do we have tools to Tango, any of the other tools that are out there to help us? And as you layer on, your quality is going to go higher and higher. To scale customer success, you're going to need high quality practices. Next step, so you understand your practices, how are you being measured? Goes back to charter as well, right? So here are some of the metrics. We were talking before the conference with the CEO of the Tango about these types of metrics. They said, yes, these are the types of ones that we think are interesting as well. But it depends, once again, on charter. If you're not focused on expansion, expansion rate is not relevant to you. If you look at how some of this data is playing out, one of the most common questions we get right now is, what's the ratio of CSM to accounts? Are you debating this in your organizations right now? Yes, right? We're going to figure this out as an industry. But it's going to be driven by the types of markets you're in, but it's also going to be driven by your charter. People that are focused on expansion, look at that, lower ratio. Why? Higher touch. If you don't understand your charter, then I would submit to you, you don't know what good looks like here. How can you know? You got to line those two things up. Let's look at renewal rates. And by the way, the other thing I will say about these metrics, I read a lot about what's being posted. Other people comment about what's good or bad on renewal rates. It is critical you're using a common definition. When we benchmark, we tell people this is the way it needs to be calculated. Calculate this way. Otherwise, it can be confusing very quickly. But this is interesting. Look, the customer success organizations focused on retention, the best renewal rates. No surprise. What about churn, right, which is different than renewal? Customer churn. This is fascinating. And the way we interpreted this data, so folks that raised their hand and said, we are focused on adoption, have the worst churn rates. What do we think is happening there? The company has an issue with churn. They're saying, we need customer success. We need customer success to keep those people on the platform. But look at the expanders. Lowest churn rate. The logic there, if you've got churn under control, now what do you want customer success to do? Start to grow those accounts, right? How can we do that? So once again, I think this is another metric. It really is going to depend. Good is going to be determined by your charter. So you have your metrics. You know how you're going to be held accountable. The next conversation is skills. And I heard a great conversation in the cafe about this. A lot of angst, a lot of struggling around, do we need business skills? Do we need technical skills? Do we need the support skills? Do we not need the support skills? This is interesting. We asked this question of where are you hiring CSMs from? And once again, look at the difference. If you're focused on adoption, you're probably going to draw more from support, professional services people that technically know the platform. If you're being chartered for expansion, look how that shifts. You're going to focus more on getting people in, maybe have a business development background, an account management background. So once again, we're in a world where one size does not fit all. And what you're looking at here, one of the other things that we are looking at is what are the coverage models, right? Through that virtuous life cycle of land, adopt, expand, or renew, expand, renew. Who does what between customer success and sales? And what you're looking at is from the most popular to the least popular models that we see right now. So the most popular model, number one, is you can see customer success, very focused on adoption, and sales owns everything else. But it is not the only model in play. The skills you are hiring, the skills you are developing are going to be driven by these coverage maps. What model are you in? Make sense? Now what's interesting here, now here I have good news for you. Because you're looking for some good news in this, right? Okay, I get good news for you. Hey, wait a minute, I just gave you the way to go get your financial funding. That was good news, all right? So this is gonna be good news as well. So this is something that the technology industry understands. We have been building and scaling human capital intensive service businesses for 40 plus years. We understand the best practices to manage what we call the talent supply chain. There is actually no mystery here. If you look at a topic like skills assessment, and once again, you want to have a quality skills assessment process in place and practices, we know what poor quality to best in class looks like. Leverage that. Don't try to reinvent the wheel on this topic of identifying skills, tracking skills, et cetera. Leverage what we already know as an industry. You already have enough heavy lifting to do around defining practices and adoption, right? So leverage what's already in place here. So we have skills. Next conversation. What are your offers? What are you doing? And here, I'm sorry, I got to go back to the little bit downside, but I just want you guys to really go into this world eyes wide open, right? Technology as a service. So I published several what I call laws. And one of them is, unfortunately, as I study the industry, feature functionality always commoditizes in a technology as a service business model. And this is a problem. Because in the industry, traditionally, software companies, hardware companies, we sell feature functionality by the pound. That's what we do, right? You want another module, you want more features, you pay more. We are right now, I would guarantee a lot of your companies are carrying that construct forward, right? That's how you're pricing. Feature functionality by the pound. The problem is that pricing commoditizes. It's unavoidable. What are we going to do? We can't sell just by the feature. We have to insert business value. This is a diagram from the B4B book I mentioned. And so we talk about how these operating models are moving off of what we call level 1, level 2 business models that were very focused on selling speeds and feeds to business models that are designed to really help the customer with process optimization and then ultimately help the customer achieve business outcomes. So you, as a customer success organization, need to have offers that play at the business value level. And so the way we look at this, we think about traditional product services. What would that be? Support, technical training, professional service, implementation, integration. It's fine, all very close to the product, all about closely married to feature functionality. There are new types of services. We call them optimized services, outcome-based services. This is where the action is, and this is where customer success needs to play. What types of services are we talking about? We survey on this every year. We do what we call an emerging offers survey, and we ask our members, what are you doing beyond the traditional product attached services? And you can see, I have to imagine that a lot of these services look familiar to you, do they not? Adoption planning, monitoring, looking at consumption. But it's amazing, it's still early days. We ask, look even for the cloud hosted companies, I'll go to the next thing here, around adoption, usage, and monitoring, not yet the common practice. We got to get on that. We have got to get on that. So it's still emerging days, but understanding which of these offers that you're going to invest in and move the needle is a critical step in the journey. And the other comment I'm going to make here, and this is a mistake that we made as an industry, when we came out with technology as a service, we said, hey, it's great, customer. Everything you need is wrapped into this wonderful thing called subscription. It's all you need. Low monthly fee. You have that going on, right? Don't need anything else. Some of you in this room I know are too young to remember this, but there was a day when you could buy a PC and get a 3-year warranty thrown in for free. And then what happened? The margin on PCs went like this. And then what'd they do? They broke it out, right? You had to pay separately. You all are on the same journey. If you have, all-in-one type of pricing, some of this stuff you're going to have to break out. And it is a myth that people are not charging beyond the core subscription. That is a myth. 80% of the companies that we talk to in these SaaS models are charging beyond standard subscription for things like premium support. I'll give you another data point here from the Cloud 20. Look at what's going on with professional service revenues. And I know that's not customer success, but the mentality is the same. We are charging customers for value add beyond core subscription. There was a time when SaaS companies were throwing PS in, implement it, get the customer on the platform, all for free. You can't afford to do that in the long term. So I want you to think about your offers and think about the fact that maybe some of these we should be monetizing. Not all, but some. And then the last step in the journey, technology. What is the technology that we are going to use to support and scale our customer success organization? So we do a paper every year called the Customer Success Technology Stack by John Ragstow. He's on my team. We think in terms of the customer-facing layer, the productivity layer, and then the infrastructure layer. But more importantly than just putting out all the pieces parts, we actually survey and we find out what are people actually installing. And it's pretty interesting with customer success right now. Guess what? We are very heavily weighted to a lot of the traditional capabilities that, for example, support organizations would have. CRM tools, knowledge management tools. You all have more analytics that we typically see. But look at the headroom. If we're really going to influence retention and expansion, and we're going to be really sophisticated about our adoption, our consumption analytics, there's different tools we need. And there's not a lot of uptick there yet. We've got to get there if we're going to scale this function. So, 7 steps. Let's go through them again real quick. Number 1, define your charter. It is not a one-size-fits-all. That's why you all, when you get in these conversations, you realize, right, that people have very different models. It's an accordion right now. It may just be adoption. It may be everything, like the Salesforce model. But define that. And by the way, it's going to change over time, and that's okay. TSIA, we have what we call a member success organization. Year 1, support and adoption. Year 2, they took over Renewal. Year 3, they were given an expansion objective with existing members. So it's a journey. But what is the charter today? That helps define the funding model. 3% to 20%, that is a hell of a range, right? That is a hell of a range. You got to figure out where you live in that, understand the practices required, and then how you're going to mature those, how you're going to take them from maybe non-existent to getting them documented to making them high quality. Define the metrics that you're going to use and benchmark those metrics. Hey, our renewal rate is X, this is great. And what you don't know is you're 10 points lower than everybody else, right? You need to understand that. Define, evaluate, and track the skills required. And once again, the good news here is we know how to do this as an industry. You don't have to reinvent the wheel there. 6, establish offers that really get to the business value layer, because as your feature functionality commoditizes, that's the way you're going to keep margin in your company's business model. I'll give you a very simple real-world example of that. Has anybody ever heard of TravelClick? Anybody? A couple hands, right. So TravelClick, subscription-based business model. What do? They come up to hotels and they say, hey, we'll basically list your hotel site. Well, guess what? There are tons of other people that can do that. That is a commodity. TravelClick actually has premium price subscription model. Why? Because when they talk to their customers, they don't say, hey, we're going to list your hotel room. The discussion is, we're going to maximize the revenue you get from that room. So yes, we have the technical feature functionality, but we have a set of capabilities on top of that. It's going to maximize your revenue. That is an outcome. That is compelling. That'll drive premium pricing. To pull that off, they need this kind of capability. So once again, you're critical to making sure that these business models ultimately become profitable. And last but not least, invest in the technology stack. You're not going to scale this. We've learned this lesson in all the other service lines and technology. Invest in the technology stack. So I said at the beginning that I really do believe customer success is critical. You are at the epicenter of making technology as a service business models profitable, period. But you're not going to get there unless you scale customer success. You can't be boutique. You can't be a one-off. You have to do this at scale. And to do that, I submit to you, these are the 7 steps you're going to need to work through. So I hope you had a great lunch. I really appreciate your attention. It sounds like you had a great 2 days. There's a lot of energy here. And everybody, safe travels. Thank you.